are going to turn in our next panel to a subject which we've discussed in several panels already, and I think I can safely say is on everybody's minds as one of, if not the most important and biggest uncertainty hanging over the world economy, and that is the future of the euro, the future of the eurozone, the future of Europe. And we're going to, I hope, in the next 45 minutes, figure out where Europe is going, if it's going to get there. Where is the bridge going, and is the bridge going to hold? And to do it, I think you have to have not just a very bright, a very strong grasp of economics and the complexities of the situation, but also an understanding of European politics and European policy making. And to do that, we've assembled, I have to say, an extraordinary panel of three individuals who together I think will bring, I hope they will disagree, but they will also bring greater insight into where Europe's going than we could possibly have asked for. And first of all, Philipp Hildebrand, Vice Chairman of BlackRock now, but as you all know, former Governor of the Swiss National Bank. Philipp, come and join us. Secondly, Lorenzo Bini Smaghi, visiting scholar at Harvard University, former member of the Executive Board of the European Central Bank. Lorenzo.
Thank you.
And finally, but last but not least, Larry Summers, not a European, but someone who has extreme experience in policymaking on this side of the Atlantic and certainly a window into crises around the world. So thank you all very much for joining me. I want to start with the short term. We're going to go to the longer term in a second, but the short term. Have we seen in the last few months a fundamental game change in the euro crisis? Or have we seen yet another band-aid that isn't going to last very long? Was the European Central Bank's decision to engage in OMT and be a conditional lender of last resort a sort of fundamental shift in this crisis? Or is it a sort of another chapter of kicking the can down the road? Philippe, let's start with you.
Yes, I would say it has been a game changer. Whether it's, whether it will prove to be fundamental or not will depend on the implementation of the framework. But I think the framework that's been put in place is a decisive one, and it seems to me that the financial markets have rewarded the cohesion, in a sense, of the framework and have rewarded, President Draghi primarily, but even Prime Minister Rajoy and Angela Merkel for sort of having set out a framework that does change the game, as it were. And the key now will be, and we'll talk about that, I'm sure, is to sort of stay on that path. They have set a path for themselves which conceptually is a game changer, is credible. The challenge moving forward will be now to decisively stay on that path and implement the framework.
But what exactly is that path? Lorenzo, one take on the last couple of months could be, yet again, the central bankers have bought time. Yet again, the central bankers have done something bold. And the minute they've done it, the politicians have stopped doing anything. In fact, they've gone backwards.
Yes, unfortunately, that's how it has worked over the last 2 years. Every time the central bank has taken an action to calm the markets, then this has had an impact on politicians, a perverse impact in the sense that it has relaxed them, and all the commitments they had made has taken much longer. So we have seen this with the LTRO, we saw last year with the S&P intervention for Italy and Spain, and the risk is now that with this intervention, this offer of intervention, now Spain and other countries will delay applying to the intervention, and all the discussion on banking union and all the rest also is delayed until the markets come back and put pressure on the politicians. So it's a kind of a perverse relationship between financial markets and politics.
Does that mean it was a mistake for the European Central Bank to do what it did?
No, at a certain point you have to lengthen the bridge. The only thing is that you have to have a view that the other side of the river is in sight, and it is in sight, but it's not clear how it will be and how quickly it will be built.
Larry, what's your perspective on this? I mean, I often have asked you how pessimistic or optimistic you are about Europe. How are you feeling now compared to earlier this summer? And I don't want to continue the analogy of the bridge for too long, but where is this bridge going?
I think something important has happened. I think the set of actions that have taken place, the OMT commitment being the most recent, has largely established in the market's mind that European unification is trump over Teutonic monetary virtue, even in Germany. And the fact that that principle is perceived is substantially reassuring in a world where it's quite uncertain what will come next. I call it substantially reassuring rather than problem resolving, because I think there remain important risks of two kinds. There remain risks of overplayed hands, and people who think they can have the euro remain stable and insist on monetary virtue in a variety of ways. And if they overplay that hand and then the bank runs start, it may be difficult for them to contain the situation. So you have miscalculation risk, and you have ultimate feasibility risk. There was a deep commitment to the gold standard at the beginning of the 1930s. It was a genuine and deep political commitment to the gold standard, but it ultimately just was inconsistent with growth, and therefore it ultimately gave way. And so that is, I think, the second risk with respect to the project. But I would certainly feel that one has to be more optimistic about the future of the euro as an institution today than one would have been 6 months ago. And I think, as one who has certainly been a part, and in some ways continues to be a part of the chorus of criticism of the Europeans never miss an opportunity in terms of decisive resolution, I think it's also important to take a slightly wider view of these things. And if you look back from where the world was 2 years ago, actually an astounding number of things have happened in terms of commitments towards more ultimate federalism and unity, in terms of central banks undertaking things that would have been inconceivable that they would undertake. And so one does have to have respect for the fact that that's taken place.
Can I just, I may have misunderstood you, but when you say that European unification has trumped Teutonic monetary virtue, does that mean you think Europe is actually heading for higher inflation and the Germans are going to be fine with it? Or does it simply mean that the central bank is going to engage in, or has the potential for engaging in OMT?
Means that at the end of the day, central banks will do what is necessary. And if what's necessary goes beyond the OMT, they will do that. That at the end of the day, anytime there's a choice between the euro falling apart and something else will be selected, even if that something else has inflationary consequences that would have been very surprising 2 or 3 years ago. I was certainly not predicting, I want to be very clear, I was not predicting that the consequence of saving the euro would necessarily be inflation, but I'm convinced, watching the actors, that forced to choose between 4.5% inflation for Europe, which means 4% inflation for Europe and inflation in that range for Germany, and a collapse, the choice that would ultimately be made would be for a period of that inflation. I believe that enormous efforts will be made to resist the choice coming to that, and I think there's a substantial chance that that choice can be avoided indefinitely forward. But I think it is a source of reassurance, which you see in bond yields, that there is a greater sense that the primary value is European unity.
We'll get to how to avoid it in a second, but I'd like to ask the two Europeans whether you agree with this.
Yeah,
and
no,
has
Lorenzo? I think that it's a bit too American the way you put it, in the sense that what you suggest is the ECB is the only game in town, and I think that's not what the ECB wants. Of course, no president of the ECB wants to be the last president of the ECB. So I think there is a commitment, but what's important is what Draghi said is, you politicians, you said that you will do whatever it takes to save the euro, so you decide who is in the euro and who is not. And if you decide that Spain is in the euro, then you do all the things that are necessary in terms of conditionality and so forth, then we'll do our part. But I think the difference between the ECB and the Fed is that clearly the ECB doesn't want to be the only game in town and wants to take actions that are conditional on clear commitments by the politicians. Now, we will see whether.
But I chose my words quite carefully. I said that in Europe as a whole, these concepts of monetary and fiscal virtue would give way to European unity. So some of the slack may well be taken up by the political figures. And of course, the ECB has exactly the preferences Lorenzo described. And of course, any responsible central bank official, much less an extraordinarily skilled official like Mario Draghi, wouldn't dream of joining in a discussion of hypothetical contingencies and what one would be willing to do in the event of hypothetical contingencies. My judgment just is that between the possibility that he will succeed in levering substantial action out of the politicians, and the possibility that if that proves impossible, he will step up and act, I think that the preponderance of risk is now that it is very unlikely that there will be a strategy that will involve ejections from the euro. Now, there was never a strategy to start World War I, so bad things happen that no one wants to happen because of cascading miscalculation, and that's still a risk. And political will doesn't defy the laws of gravity, and it doesn't defy the laws of economics either. And this kind of currency union is a very complex thing. So there are real risks, but the risks of a basic failure of the will of European institutions have, I think, very substantially receded.
Let me turn that to Philippe, because you have a lot of experience as a central banker. Explain to me, and I think this is sort of going on from the point that Larry made, how can the ECB make what is effectively a conditional commitment to save the euro at all costs, which is, if you put together what Mario said in August with what the ECB's action was, it's, on the one hand, we will do what it takes to hold the euro together. On the other hand, it's a conditional commitment, and countries have to be in a program. So let's assume, and I think this is not an absurd hypothetical, Spain applies for a rescue plan. The markets at some point start worrying. The ECB starts buying Spanish bonds. Spain then goes off track. Every single program has gone off track at some point. Spain goes off track. Is it credible to think that the ECB will then stop buying bonds? And if it doesn't, how will Jens Weidmann and the Bundesbank react?
Well, I think that's the core of the question. That's, in my view, as a former Teutonic central banker, I think that
but
is... But
now an Anglo-Saxon, is that
exactly. But that is the key of what I think President Weidmann is concerned about. I think this story is less, in my mind, about the legality of the framework that Mario Draghi has laid out, and it's much more about, when it comes down to it, can you actually live up to this conditionality commitment? And I think that's, to what extent can the central bank make sure that the other side, in this case the politicians, actually do their job and they don't end up holding the bag by themselves. I think that is the ultimate concern that is behind the Bundesbank's position, and you have to have some sympathy for that. Now, I think the pragmatic question is, okay, so you accept that that's a problem, but then, what's the alternative to what's been laid out? And I would certainly echo what's been said, that this is a reasonable step if you have the view that we need to move forward on this and not move backwards and go towards this integration. In the end, the way I look at it, there are only three ways conceptually to resolve this crisis in Europe. One is, through higher inflation. The second one is through the hard path of reform and structural and fiscal, and eventually a return to growth. And the third one is, in a sense, conceptually by way of debt restructuring or debt default. And I think in the end, from an investor's perspective, the question is which of these three, or rather more likely, what combination of the three paths will be chosen? I would be, again, as a former central banker, more, I guess, on Lorenzo's side to think that the inflation part of it will play a relatively insignificant role in the adjustment process moving forward, simply because I think the commitment to price stability over time, not quarter by quarter, maybe not every single year, but the commitment to price stability over time remains a very firm one in the European context.
So then, of the other two?
Well, I think, look, the sort of $1 million question at the end of the day, I think, is can we get through this without significant further sovereign debt restructuring? To me, from an investor's perspective, that's the key question.
And we're going to get to that as the next topic in a second. But Lorenzo, I just wanted to bring you in on the ECB, and you've been in those meetings.
No, but
Tell
I
us
think
what it would be like.
if the proof of the fact that the ECB will act as it promised, it is that if Spain or whatever country goes off track, it will stop, is what we have observed over the last 2 years. I mean, had the ECB acted like the Fed, taking out all risks, we would not have the crisis over the last 2 years. The crisis was there because the ECB intervened, and when the other side, the political side, did not step in and do whatever it needed to do, then the ECB stopped, and the spreads went up. So I think the track record of the ECB should be taken into account by politicians. And to some extent, we have talked a lot about the ECB and the announcement of the OMT as the key game changer. And that's true. But if you look at other issues in Europe, if you look at Greece, at the elections in Greece, I think, in my view, these have been a big game changer because people in Greece, in spite of all the hardship, have said we want to stay in the euro. The government which has come out, is doing the right things. And the government is doing the right things because it knows that if it doesn't do the right thing, it will have to leave the euro. So in the end, the threat is there. And unfortunately, it's a kind of moral hazard which has to be dealt with, but is leading very slowly to the right adjustment. And I think the Greek situation, in my view, is very important to eliminate the risk of exit that Larry was mentioning and add to the credibility of the ECB in the way it will.
Larry, I'm going to turn to you in just a second, but on Greece, do you really think that the change in the last few months has been a significant change in Greece, or more importantly, in my view, a change in Berlin, that the view is actually it's going to cause more problems than it's worth to have Greece exiting, and so a much greater sense of willingness to compromise?
It's a combination. I think you cannot sell in Berlin the Greek attitude of last year, where they were saying, you have to help us because it's in your interest. I think the new government is really taking tough actions. They're doing the right things. They just say we need more time, and I think they have convinced the Germans that. And the Germans have no interest in having a crisis during the election year. I think that's another maybe thing that the markets are trying to incorporate. Probably the kind of verbal interventions that Merkel is doing, even by going to Athens. So politicians are starting to behave like central bankers.
But I think there's
just
also
one second, because Larry's been very patient. Larry, you wanted to come in.
I want to make 2 points. The first is that this dilemma of what's the central bank going to do and what happens if the country doesn't do what it should, this is not a new story. Every financial crisis is different, but every financial crisis, the provision of conditional assistance has the same plot. When you're providing the conditional assistance, you always have 2 objectives. One objective is to reassure the markets that everything's going to be okay, for sure, so they just are confident and carry through. And the other is to scare the country in question that the world is going to end if they don't do what they need to. And you always are constrained because because the world listens, and you can't say different things to the 2 constituencies. And so the crisis manager never looks very graceful because guys in suits, guys in their 50s in suits on surfboards never look very graceful. And they're trying to balance these two objectives. And they do it, and the conditionality isn't quite as real as it seems because you have to have the confidence imperative, and the confidence imperative isn't quite as real as it seems. And that's what has to be balanced, and that's what's basically going on between the ECB. It's a little more complicated this time around because it's not just the funder and the country in question, but it's the principal funder and the other countries and the country in question. But this is basically a familiar plot where conditionality has a credibility problem. And that's there in every crisis. The other thing I wanted to say, because I don't want to be misunderstood in this, I have never been a central banker, but share the central banker allergy with respect to inflation and do not expect or forecast or desire to see significant inflation in Europe. What I would point out is that I think one of the things that we've learned that would surely come as a surprise to German monetary thought as it stood 5 years ago is basically everywhere in the world that the link between the amount of central bank liquidity created and the rate of inflation is more tenuous and less rigid than many had supposed. And so the capacity to purchase a certain volume of Spanish debt without creating inflation is, I think, greater than would have been imagined at the time the ECB was started. And the last thing I'll say is, in terms of competition about who's overstepping what mandate and bailing out all risks, I am not aware that the Fed has made itself a buyer of last resort even a little bit for securities that in the pure market would have spreads of 300 or 500 or 800 basis points. And so these comments about the relative moral virtue of the ECB come as a bit of a surprise.
Larry, we have enough to debate staying in Europe. We don't need to argue about the Fed. Let me just pose to you the question that Philippe raised. If you think, as you've just said, that inflation you don't expect or want to play a big role, of the other two alternatives in dealing with the debt stock, debt overhang, austerity and or structural reform and restructuring, which do you think will play a bigger role?
The question is to Larry?
To Larry and then to you. I'm not letting you off the hook either.
It's too explicit a question to get answered.
You've never not answered a question because it was explicit.
That was the kind of candor for which I'm known. Look, I think there'll be elements of all three. Will inflation, will European inflation over the next 5 years in a happy scenario be quite as low as people would have envisioned it being a few years ago? Probably not. Probably not quite. Is there a lot that needs to be done with structural reform that will energize growth? Yes. There's some. I think it's a very long way from conclusive, but I think a fair-minded skeptic about the structural aspects would concede that the step up in exports in Portugal and Spain has been more impressive over the last months than they might have expected, so structural reform will have a role. Have we seen the last debt restructuring in any European country? I don't think the sovereign debt restructuring in any European country, certainly even with the rally that has taken place, you interpret market prices, spreads of several hundred basis points in a number of different countries, project that out 10 years, allow for a recovery rate. Yes. And the answer is the market is making a judgment that there's a significant risk that we have not seen the last restructuring.
Do you share the market's judgment?
And I wouldn't think the market's judgment that there's a significant probability is one that one would want to dismiss.
That is the least sort of...
Very, very diplomatic.
The most diplomatic answer I've heard for a long time from you. Lorenzo, can you be more direct as the ECB central banker?
I think we've seen what debt restructuring of a sovereign means. and it's quite disruptive, I think. And this has been the mismanagement of the Greek case, I think, has been one of the reasons why we're still in this mess. So I think if we could get this risk out of the market, and it's, by the way, the pricing is changing day by day, and I think the markets, those who have made money, have bet on these spreads coming down. And if they come down further, like in the Irish case and in the Portuguese case, and we eliminate part of this risk, then we are in for a long period of slow growth and Japanese scenario, which some people would say would not be that bad after all for an aging society like Europe.
So you would prefer that? You would prefer an outcome that did not have restructuring but had a long period of slow growth and very high debt burden?
Well, that's, I mean, we have a whole debate about austerity versus
we'll get there in a
whatever.
Second.
And some people say that shock treatments are worse than very gradualistic. And it's sometimes, I find it strange that this is not applied to debt restructuring. Debt restructuring is a shock treatment with a huge impact on the economy and the society. So I think maybe some gradualism is preferable than uncertainty. I think that, by the way, if you have a shock treatment in Europe with major debt restructuring, this will spill over to other parts of the world, and I think we could be in a big worldwide crisis. So we have to be careful when looking at sovereigns in particular.
Philippe, I'm now going to ask you to answer your own question, or put some odds on the different paths that you laid out. Do you think there'll be sovereign restructurings?
I think, Larry put out a nice framework. In the end, a lot will depend on the global economy, the dynamic in the global economy. I think I can certainly see a scenario where we can kind of get through it without. On the other hand, if you had further deterioration over the next couple of years in the global dynamic, some other external shock to the system, I think it would become very difficult. And given that the probability is not zero, as Larry has said, or is not insignificant, it seems to me it's worth thinking about how could you prepare yourself. These things are dangerous, as Lorenzo said, but not just sort of pretend that the issue isn't there, and then if it happens, be entirely unprepared, as we were in the case of Greece. That's been sort of a point that I've been trying to make for years without much success. It's not that different, from the kind of resolution debate around banks, where, frankly, we're still wholly unprepared to deal with a cross-border problem of one of the most significant banks. So, by the way, just one point to give some hope to the sort of gradual scenario. There, one of the things that is often neglected in the Anglo-Saxon commentaries, a lot of adjustment is actually occurring, is taking place. If you look at unit labor cost in the peripheral countries, it has come down very significantly. They've probably come down more than a third of the deterioration of competitiveness has been adjusted. You look at the current accounts, a lot of them are heading towards balanced current accounts. You look even at the fiscal balances, and we should not lose sight of the fact that if you look at the data, the strategy is yielding results. The problem is we're going to need another 2 or 3 years, and the question is whether that can be sustained.
We'll get to the fiscal in a second, but just to push more on the consequences of restructuring and the link between sovereigns and banks, because that's part of the vicious circle that makes the European situation so problematic. Do you think that more needs to be done on the banks? And if so, how do you mentioned trying to kind of think about ways that you make sovereign restructuring safer. What would you do to the banking system to allow that to happen?
Look, big picture sort of comment. What has been missing in Europe, sort of tragically missing, is the step that the US took with the stress test exercise, where Tim Geithner sort of came out decisively and said, that's it, Here is what's going to need to be done. We're going to need to recapitalize the banks. Either you do it yourself or we're going to stand behind it and do it. And I think looking back in history, I'm sure that will come down as a very decisive and perhaps the most valuable moment, or one of the most crucial moments in the sort of US crisis response. I think that was a historic act, very courageous. We never really had that in Europe. As a result, if you look at lending, lending is up something like 15-20% since the stress test in the US. The banking system, the banking concern has essentially been taken off the table in the US. You have credit flowing again. And in Europe, we never got to the point where the markets felt completely comfortable that the banks were actually sufficiently capitalized. Now, there are reasons why it's a lot more complicated in the Eurozone than it is in the US. I'm aware of all those reasons. But ultimately, the sort of tragic thing that's been missing in the European crisis response is to once and for all decisively kind of take the bank concerns off the table. And we're still not, that is still one of the kind of big missing links in the story.
Lorenzo, can I just ask Lorenzo and then we'll get to you, Larry. Lorenzo, do you agree with that?
Yeah, I mean, I think Philipp said this in a very nice way. It's sometimes the form is as important as the substance. So the gesture to regain credibility is very important. And simply in Europe, we don't have a single supervisor. And that's why this change to a banking union is so important, because you need somebody who is able to credibly go to all the banks and say, you need more capital, and unless you get it.
And do you think the ECB will be able to do that even under this new framework?
Well, I think the ECB, we will see what will be the powers in terms of which banks it will be supervising, and whether it will be able to supervise or to dictate the stress test also to smaller banks. But that's, the incentive of national supervisors is always to reveal less than what is the reality, and because the European system is partly in competition. National systems are in competition between each other, and a European supervisor, I think, would have the authority to make the stress test credible, to ask for a credible recapitalization, and to calm the markets from that point of view.
Larry.
Look, I sympathize with the Europeans' challenge. What was done in the United States worked out extremely well. I think a fair-minded observer would have to acknowledge that transparency is a great strategy when things are better than people think they are. Then enhancing transparency tends to be followed by good outcomes. But it isn't always true that reality is better than people think it is, and so a transparency-focused strategy sometimes is more complex, and that may be the case in Europe. I have to say, and I speak as somebody who's on the other side of the Atlantic and doesn't follow it as closely as my two colleagues, I sometimes listen to these discussions of European banking policy, and it feels like a discussion of the post-war Navy in 1943. I'm sure in 1943 it was important to think about the post-war Navy, but it was actually a lot more important to think about what the Navy was going to do to win the war. And so it seems to me the central, we're having what we trust will be the financial crisis of a half century, the financial crisis of our lifetime. And so the fraction of the discussion that is about what the regime will be after the crisis, when the institutions have all been recapitalized, seems to be about as classic an example of a summa can opener as I've seen among serious policymakers. And so it seems to me the real questions involve the approach to be taken to a set of institutions that appear to be constrained by financial exigency in their behavior to a substantial degree, and to a set of sovereigns whose financial position is imperiled by their connection with their banks. And it seems to me if you're talking about financial policy and those two subjects aren't an important part of your conversation, you're probably missing the point.
But you fortunately have the European Central Bank, to continue your 1943 analogy, to sort of wage the war in the short term, while you can then plan the post-war.
Just but one point, Zanny. I was at the table when Basel III was finalized, negotiated, and I can only echo what Lorenzo said. My biggest frustration, by far, was that you could never feel a sense of comfort. There were a couple of exceptions, but not many, that the national supervisors really gave you an adequate picture of what was going on, or even of what they knew in their largest banks. And that, I think that was, if I had to sort of point to one thing that was fundamentally flawed in both the crisis response process as well as the rebuilding or the regulatory reform agenda, it was exactly this sense that the national supervisors, could not help themselves but be captured by politics. And that made it very difficult to ever get any kind of comfort that you were actually looking at an objective picture of what the vulnerabilities were in the banking system.
We're going to turn to questions in just 1 second, so do get ready for that. But just one last area where I hope there's some disagreement between you, and I assume there is,
right,
on fiscal policy, where, Larry, you've been very critical of the European approach to austerity, to fiscal consolidation, but you did say just now that an underappreciated part of what had happened in Europe is that some reforms had taken place and there was some improvement. Do you think history is going to look back and say that it was a huge mistake what the Europeans did on fiscal policy, or are they going to say, well, actually, they bit the bullet and they got going earlier?
I don't think that the benefits, if the export performance in Spain and Portugal proves to be durable, I don't think it will be a result of the deficit reduction. It will be a result of the fact that slack does more to drive down unit labor costs more quickly than I might have expected. It will have to do with the fact that difficult times force efficiency. It will have to do with the fact that there were various structural changes. It will not primarily have to do with the consequences of greater and more front-loaded austerity. I think the evidence for the confidence-enhancing benefits of front-loaded austerity proving stimulative in environments where interest rates can't fall and exchange rates can't adjust is close to non-existent. So it does lead me to appreciate more, to recognize that the single currency, that perhaps there are more adjustment mechanisms than some would have expected. I think that is a valid point. But on the question of the risk calculus around austerity, the potential counterproductivity of austerity, I think the evidence both on the continent and in the UK speaks to reinforce those concerns.
Lorenzo, you, I think, were quite a strong advocate of tough fiscal austerity. The Europeans maybe haven't changed as much as Larry would like them to, but there seems to be a lengthening of consolidation periods. There seems to be a moving away from the very harsh upfront fiscal cuts. Do you think what the Europeans did was a mistake?
No, I mean, this debate makes an assumption, is that you can do fiscal retrenchment the way you like it. And that's not the reality. It depends a lot on the markets and where the market. I mean, Spain would have loved to have a smoother adjustment. Italy too. Greece would have loved to have a smoother adjustment. The fact is that when you lose market access, you often lose market access because the market doesn't trust.
Has Italy lost market access?
No, I mean, I'm not coming to that yet, but certainly interest rates went up because they were not trusting the fiscal strategy to be sustainable. So then when you get into this zone of losing market access, then you need help. And you need help either from the central bank or from the other countries. And of course, if you need a lot of time, it means that the other countries have to give you a lot of money, and this that's the German position, that puts into jeopardy their own fiscal position. So I think the debate is a bit more complicated in the sense that, and we see this with Greece, if Greece needs 2 more years, we need to find more money. And they had to go from 15% to close to 0, and you can't take 10 years to do that. You have to, especially at the beginning, not forgetting that they moved from a deficit of 8% to 15% in 1 year. So, I mean, it's always painful to go back, but I mean, there was a kind of a stimulus which was, so I think like for monetary policy, it's the same. You have to calibrate the appropriate pace of reduction, and you have to look at all the variables and be careful not to lose market access.
Let's open the floor to questions. If you could introduce yourselves and pose a short question. I can't actually see. Yes, gentleman there.
Specific question to each of you. The likelihood of Greece being in the euro 1 to 2 years from now, Do you think that's highly probable or still a little too early to forecast with confidence?
Why don't we ask them to assign a probability? Greece in the euro 2 years from now. You can have a range, but assign a probability. Larry.
Markets, I think,
Don't hide behind the markets, Larry. Come
markets,
on.
I think, regarded as a substantial, regard there's being risks both ways, but as significantly more likely than not.
That's
More
what you're going to
likely.
say? Markets regarded as significantly more likely than not.
More likely to be in the euro.
You think more likely to be in the euro?
In the euro.
Yes, I would agree. And the reason is because, you know, people have realized that an exit, and again, there's an analogy here to bank resolution. It is not true, it is decisively not true that not being there anymore would be a cost-free kind of alternative. Yeah. So I think that makes the probability that it is highly likely significantly higher, because an exit is not a way to sort of save money, frankly.
Lorenzo?
I think the choice ultimately depends on the Greek people. That's clear. And the choice is not to devalue, is give me back the euro and you get a drachma against. So that's the kind of choice. So you must be in a very desperate situation to say, yes, I get the drachma and I give up the euro. And we're not there yet, and hopefully we'll never get there. So I give a higher probability than what the markets give. So
Next question. No more questions? Oh, yes, gentleman here in front.
Thank you. This is a question for Mr. Hildebrand. Mr. Rajoy is getting a lot of pressure to formally ask for the bailout. He's postponing that, at least from a formal perspective, that decision. What is your opinion on the aspects or on the consequence, positive and negative, of postponing that decision? And especially, will your mind change if you were a Spanish citizen?
Look, let's be realistic. To some extent, requesting or activating these programs has something of sort of temporarily ceding some part of your fiscal sovereignty, or maybe even some extent, depending on the program, some structural policy sovereignty. That's not a pleasant thing to do. It's a difficult thing to do politically, so I have a lot of sympathy for those difficulties. At the same time, I think it's very important what I said earlier. The markets have rewarded the framework that's been set out by Mario Draghi, but in conjunction with what's been said by the Prime Minister and by Angela Merkel. That has led to a very positive market dynamic, which has led to a substantial compression of yields. In my mind, it is very important and in the interest of everyone to seize the window of opportunity that has been opened up and kind of work with the markets, as opposed to falling into the trap that Lorenzo has spelled out, to sort of each time have markets start to work against you, and then you have to work against markets. And what we've seen in the last couple of days, of course, is to some extent a bit of a reversal of the very positive trend that we've seen since the announcement of the ECB. So I think the ultimate probability of success is much higher if the government of Spain, together with the German government, together with the ECB, now take decisive action to put the framework that's been put in place, that's been judged to be credible by the markets, to activate it, and activate it decisively. If you wait, and we end up in Lorenzo's sort of paradigm of the market work against you, eventually you're forced into it, I think the probability of success, ultimate success, goes down. So I think in that framework, it is very much in Spain's interest, as much as it is in Germany's interest and in the ECB's interest, to act decisively. The odds that you can get away without ever acting, that speech is enough, I think the odds of that are very, very small. So therefore, the sooner, the more decisive action is taken, the more decisively that window of opportunity is seized, the higher the probability that in the end it will yield a successful outcome.
Lorenzo, can I just ask you to add to that, and add to it from the perspective of Italy? Shouldn't Italy ask for a program soon too?
Well, I think the issue is very clear. You cannot get out of restrictive fiscal policy jointly with a restrictive monetary policy. That's what we have now in Spain and in Italy. Fiscal adjustment is sustainable only if you have an accommodative monetary policy. Now, how can you have an accommodative monetary policy with the kind of transmission mechanism, to use Draghi's words, that doesn't work? The only way is to go through a program. So the keys to have an accommodative monetary policy is in the hands of the Spanish government and Italian government. If they don't turn the key, then I think they're bound to have the combination of two things, which is, from a textbook point of view, I think Larry would concur, it doesn't work. You cannot have a restrictive fiscal and monetary policy which provides a lasting, sustainable debt reduction over time.
Does that mean that, just to make sure I understood you rightly, if these countries go into a program, the ECB should push down their bond
ECB
yields
will
further?
do that. We'll bring, and that's what Mario Draghi said. We will intervene to make sure that the monetary policy that we have in Germany will be the same as the monetary policy that we have in Italy or in Spain, which now cannot be the case because of the spreads which are so high.
That means bond yields much closer to German
Yield.
bond
But it's not
yields.
only bond yields, it's the rates that banks charge on customers, on households and companies. The private sector is not getting out of this crisis, and that's very important. I mean, these are the guys who pay the taxes and which make the fiscal adjustment. So it's not only, I mean, many people in Spain and Italy look at the public sector as, you know, the sustainable debt, and what's the sustainable interest rate to make the debt adjustment. But the private sector is much more important. As long as the banks in Spain and Italy will charge high interest rates, and they charge high interest rates because of the spread on the debt, I mean, the economy will not recover, and you would not have a sustainable...
Does that require a scale of intervention that people aren't really comprehending right now? I mean, it's one thing to get sovereign spreads down a bit from where they are. You're talking, if I understand you rightly, of something considerably more ambitious.
Well, Draghi mentioned monetary policy. I mean, monetary policy, the transmission is not working, so you have to make monetary policy work, means that interest rates have to come down substantially.
I think it also depends, Andy, very much on, again, if this can happen with the markets in support of the whole process, frankly, the amount of interventions will be much less than if you wait until things deteriorate and the whole program gets kicked into action under adverse market conditions. So it is deeply convinced that it's in the interest of everyone involved here to act decisively and put the framework into action now.
We are running out of time, but I'm going to beg the indulgence of my colleagues to end by asking you all very briefly one longer-term question. And please, Larry, be more specific than you have been. In 5 years, give me a 1-minute view of what the Eurozone is going to look like. Who's in it, broadly, but what's it going to look like? And I'm going to ask the two of you the same question.
It will have its current members. It will have experienced very slow growth. There will have been 2 moments of significant financial trauma around either countries or big institutions, but the basic unity will have been preserved. Radicals will not have come to power around the disillusionment, but the fraction of parents who think their children are going to live better lives than they did will be distressingly low.
Thank you. Lorenzo?
Well, I'm afraid I agree. Maybe I would push to say that maybe there will be more countries which not necessarily Switzerland, which is a candidate. Switzerland will not join. But I think that the way in which politics work in Europe is that to prove that the euro is solid, they will be tempted to get a couple of Baltic countries, I think, also to rebalance North and South. So I am ready to bet that 5 years from now there will be more countries, not many more, but a couple maybe join.
Thank you. Philippe?
I would simply add to this, so basically I would be in the same camp. I would add that in order for that to happen, certainly if you look 10 years out, there has to be some incremental steps initially towards a model that is politically more integrated. It's not going to be the United States of Europe, certainly not in 5 years and probably not in 10. But there will be a change at the margin initially to the degree of fiscal sovereignty and maybe even sort of structural sovereignty. And we will begin to see a model that starts to approach some of the models that you see in countries such as federations such as Switzerland or Canada, where you start to have some transfer mechanisms coupled with less than absolute sort of national sovereignty on the fiscal and probably also on the structural side. How much of that we will see in 5 years is an open question, but we will begin to see, if it is to work, we will begin to see measures in that direction. Those will be very difficult constitutional debates, particularly in Germany and in France. But they will have to take place. Otherwise, I don't think we can get to a stable equilibrium 5 or 10 years down the road.
Thank you. You had one very quick two-hander.
I want to make notice that Philippe says there are a lot of preconditions before you can even get to the highly optimistic outcome that Lorenzo and I predicted. I want to say one last thing at a conference sponsored by the Economist magazine. This didn't have to happen. This is a tragedy that's affecting the entire world and is affecting hundreds of millions of people. And it didn't have to happen. And there are a lot of reasons that it did happen. But I think a very powerful reason is that people believed in the triumph of politics over economics. Much of what has happened was a predictable consequence, predictable and I might say predicted consequence of seeking to have a common currency with so little else being unified.
So
and a judgment.
At the last, this is like the presidential debate. You put at the last, when nobody can answer, you put this little pill of wisdom, which I totally. I mean, look at the history of the U.S. Look at the history of the U.S.
And a judgment
not
was
create.
You know what? I'm going to do what the presidential moderators did not do, which is I'm going to allow you 30 seconds and you a minute to respond, and I'm going to forgive you, and you'll all have slightly less coffee break time, but I think it's worth it. But that is it. So 30 more seconds, Larry.
And a judgment was made that if there was sufficient political will, the laws of economics would just sort of get repealed by that common desire. And that was a serious error. And that's why anytime somebody prefaces their comment about what next by saying what's really important isn't the economics, it's the politics, they are at risk of compounding the error. And my hope would be there could be a lot more rigorous focus on what works economically, as well as what political formulae are convenient.
Thank you. Lorenzo,
No,
it's only fair you get it.
Certainly the economics are important, but the whole history is built like this, Larry. If you look at the US, they didn't start with a federal, not even a Federal Reserve. They had to realize that there were crises because they were no lender of last resort, so they had to create a Federal Reserve after 100 years with the dollar. The federal fiscal system that we know was created after the tragedy of the Great Depression. I mean, that's how, I don't want to excuse politicians nor even citizens, but that's how a bit like our democracies work. They tend to move addressing crisis, and if they don't see the crisis, it's very difficult. I mean, I tried to argue at the beginning of the euro that we need a common supervisor. But people said, why do we need, I mean, where's the problem? I mean, they didn't see the reason. They were seeing the reason for having a single currency, but they were not seeing to avoid the kind of exchange rate crisis. They were not seeing so that's how human nature evolves and history evolves. So we have to be a bit more optimistic that, economics is very important, but sometimes you need to solve problems which you have to wait that they are there in order to be solved.
Thank you. In the interests of being fair, Philippe gets
Yeah.
a few seconds too, and you do then get coffee.
30 seconds.
That's how
I would simply say, the Swiss history would be another
Yeah.
example, by the way, of this. I would simply say where we are today is not a long-term stable equilibrium. And so there's really a choice to make. You either move forward, which implies these integration steps, and you can go historically, slowly, gradually, or we're going to go backwards. And I think what we're all saying is, we believe the forward movement is possible, but that means politically and economically you have to be prepared to move from the current situation, which in my mind will not prove to be a stable equilibrium.
That is a perfect note on which to end. Thank you so much. I promised you an interesting discussion. It was. We now break for coffee and come back here in 15 minutes.